You file your taxes every year. You follow every rule. You still pay more percentage-wise than some billionaires. That's not an accident. That's a strategy. And the real answer is far stranger than the rich just cheat. Your income gets taxed the moment you earn it. Their wealth doesn't work that way. Most of what they own isn't income at all. It's unrealized value sitting in stocks, real estate, art, companies. And unrealized value, under current law, isn't taxable. Not yet, maybe not ever. Here's the move. It's called buy, borrow, die. Economist Edward McCaffrey coined the phrase, and it explains more about modern wealth than almost anything else. Buy assets that grow in value. Borrow against them instead of selling them. Die, and your heirs inherit those assets at their current value, wiping out the gains that built up during your lifetime. No sale, no income, no tax. Sounds like fiction. It isn't. Banks will lend against a stock portfolio the same way they'd lend against a house. The loan itself isn't income, so it isn't taxed. The wealthy live off these loans for years, sometimes decades, while their actual assets keep compounding untouched in the background. Meanwhile, a salaried worker gets taxed the second the paycheck lands. Why does this loophole exist? It isn't a glitch. Tax codes were built around a simpler world, one where wealth mostly came from wages, not portfolios. Lawmakers taxed what was easy to see and measure: income, a number on a pay stub. Nobody built strong rules for wealth that just sits there, growing, never cashed out. And once that gap existed, people with enough assets to exploit it did. Your ancestors understood something about resources that got lost along the way. In early trade economies, wealth wasn't just what you held. It was what you could move, hide, or delay handing over. The merchant who didn't have to liquidate his goods before a tax collector arrived kept more of what he built. The modern version just wears a suit and uses a spreadsheet. Is this fair? That depends who you ask. Economists like Emmanuel Saez and Gabriel Zucman have spent years arguing this exact structure is why wealth inequality keeps widening, even when income taxes look progressive on paper. Their research shows the ultra-wealthy often pay a lower effective tax rate than the middle class, not because the top rate is low, but because so little of their wealth ever becomes income at all. You don't need 8 figures in stock to notice the shape of this pattern in your own life. Every time you delay a decision to avoid a cost, every time you borrow instead of sell, you're using a smaller version of the same logic. The wealthy just built an entire financial life around it. So the next time you glance at your paycheck and watch a chunk disappear before it even reaches you, remember what you're really looking at. Not a universal rule of money, just the part of the system that was built to see you.